Hey, welcome back to another episode of E-commerce on Tap, brought to you by Sourcify and ISBA. I'm your host, Nathan Resnick, joined by my co-host, Aaron Alpeter. Aaron, how's it going today?
I'm doing good. I'm still getting used to Montreal. I woke up today and it was 53 degrees in August. I'm
Wow,
like, what in the world is going on? But
that is crazy. That is crazy. Well, I am dog sitting, so if anyone hears any dog whines in the background, I apologize in advance, but I never knew how much work it was to handle three dogs at one time. I mean, that is a lot going on in this house right now. But hey, it's great to be back on e-commerce on tap. For those that are tuning in for the first time, do you want to give a quick kind of overview of what e-commerce on tap is?
yeah, besides being the highlight of our weeks, what we do is we pick a well-known, typically venture-backed company, tell their founding story, reverse engineer their supply chain, and then talk about kind of what the future looks like for them.
Awesome. So today we're covering Thrasio. I'm sure many in the e-commerce world know a lot about Thrasio. We're going to be diving deep on their acquisition strategy, their supply chain, really their whole business, and also kind of their exit and bankruptcy and everything that's going on with that. So excited to touch on Thrasio. But before we dive deep there, are there any interesting tidbits that caught your eye the past week?
Yeah, I've been looking a lot at kind of the changes with Pitney Bowes. So, for those of you who don't know, you probably received a package from Pitney Bowes, but they've been around for, gosh, over 100 years. And they've really been like letter deliveries is how they got started. And they made a big foray in the last couple of years, last decade or so, into e-commerce and parcel delivery. And so they were an option that was competitive to like an on track or DHL e-commerce or things like that. And they have gone through a massive restructuring where they've basically gotten out of that business completely. They sold their e-commerce operations. They've gotten out of the small parcel delivery pace. And yeah, it's just been kind of a huge shift there. And there's a lot of parcel companies that I know that are scrambling to pick up those customers. But as I was taking a step back and thinking, okay, why and why now? Um, the economics and the challenges of parcel haven't really changed. But what has changed is the changes that the USPS wanted to make to Parcel Select. So we talked about this last season, where they announced these rate changes, where they're effectively getting rid of the work share program, and they were increasing the rates that they were charging companies like Pitney Bowes for their postal induction. And so they were going to charge you more if you basically did more of the work and put in there. And so this is really what I point to as the market's first big change, where they're reacting and saying, okay, we understand that USPS is changing the rules. This is not an interesting business that we want to be in. And so rather than trying to figure it out and losing money, we're just going to exit it and we'll see what happens. We'll see if OnTrack or OSM or DHL, gets into that as well. Does the USPS want to take all this volume and do it internally? Yes. But when you look at what USPS is looking at from a volume perspective, they're only forecasting very modest increase. So they're going to lose a bunch of revenue, but they're not accounting for increases in volume. So that's going to go somewhere. My bet is that this is going to end up eventually flowing through Amazon Logistics as they begin to open that up to more and more, off-market platform sellers on Amazon.
That's super interesting. That's a good take. For me, I probably spent a little too much time looking at stocks, and so I was at the gym and saw someone wearing Allbirds and just looked up the Allbirds stock, and it's kind of just interesting to see how these e-commerce companies have performed publicly. And the valuation currently of Allbirds, doesn't make a ton of sense to me. I mean, the market cap's around $100 million. They have 87 million of cash and 53 million in inventory and basically no debt. But the business has been declining like about 25% year over year and losing 19 million a quarter. So I mean, it's interesting. I mean, it still, puts up 200 plus million in revenue a year, but, just public investors do not have an appetite for companies like Allbirds right now. And I think, as I kind of looked at the market as a whole, the only e-commerce company that's still doing really well from a performance standpoint that went public in the past, 5 years or so is Figs. And, they've got a great niche and have done really well, but it was just interesting to see, kind of how these companies have performed publicly.
Yeah, that's a really interesting point. And if you just look at the valuation, so the $87 million of cash that they have plus the $53 million of inventory and getting to that valuation of 102. If you're losing $19 million a quarter, they're basically, the market's basically saying that you're going to continue to lose money for the next 2 quarters, and then you better have it turned around at that point. So I think they just had a CEO change recently, and so it seems like the market's basically giving them 6 months to turn it around. Otherwise, they're going to potentially take it down further. But would you buy Allbirds at this point, like the stock, or would you want to wait for that?
I mean, I would think there'd be a strategy to kind of, well, we're talking about a roll up today, but I think there'd be a strategy to kind of go in and acquire a lot of these e-commerce brands that have gone public that have, a lot of revenue, are losing money, but just acquire them, take them private, and kind of create this conglomerate of e-commerce companies that were previously public and roll them together and, streamline operations. I think you could make, quite a bit of money doing that. Um, and it's interesting because today we're talking about kind of the darling of Amazon e-commerce roll-ups, Thrasio. And for those that don't know Thrasio, it is a consumer goods company that acquires and scales Amazon third-party businesses. And they focus on data-driven strategies that optimizes operations, enhances their marketing efforts, and expands their product lines. And Thrasio, is really kind of the darling of this aggregator space. They were the fastest unicorn or fastest company to hit unicorn status. At the peak, its valuation was over $10 billion. I mean, it's pretty insane to see what the Thrasio team accomplished in such a short amount of time. But as we'll dive into, they now are kind of just finishing up their bankruptcy proceedings, and we've got a lot of interesting tidbits to cover there on the end. But I guess for those that aren't familiar with the e-commerce aggregator space, that aren't, really understanding how this process works, and you want to kind of give an overview and explain kind of how this model came to be?
Sure, and this is an area I have quite a bit of experience with. I've got friends that have started roll-ups and aggregators, and really just the idea of a roll-up is nothing new, right? This has been around for a long time, typically in private equity, and what they do is they find businesses that are doing okay, and they stitch them together. I've got a friend that was rolling up roofing companies in Europe, and they're just like, "Yep, we're gonna come in here. We're gonna buy all these small companies that might have a regional presence. We're going to integrate the back end. We're going to centralize the marketing. We're going to keep their brands. But effectively, we think that we can operate these businesses better than they can on themselves. And so we'll be able to increase the multiple of what it is. And then eventually these businesses will be big enough that somebody will want to buy them. And so this has been a playbook for a long time in PE. I mean, every nursing home is basically part of a roll up at this point, funeral homes. You look at charter schools, things like that have really become acquisition targets for private equity. And e-commerce aggregators is really just taking that playbook and applying it to the D2C space or the e-commerce space. And so the thought here with an e-commerce aggregator is that you're going to buy lots of smaller to medium-sized brands and hold them under one umbrella. And if you believe in those businesses, if they're fundamentally sound themselves, then you can start stacking quite a few profitable businesses to make a larger profitable business. And then the idea is that if you've got stronger procurement practices, stronger tech, maybe better expertise, you get greater leverage by summing up all of those brands that you would individually. And so that's the basic idea. And it's something that, Thrasio wasn't the first one to do this, but really was the poster child for the aggregators. I think that everybody wanted to be Thrasio. People raised money of hey, we're going to be the next Thrasio for X. And so it really became something where in the late 2010s, early 2020s, a lot of brand owners who had started side hustles saw aggregators as a great exit opportunity. And so the thought would be like, hey, I'm going to grow this to a couple $100,000 in EBITDA, and I don't want to do it full time, but I also, it's too much money to give away, or, just to not have anymore. And so I'm going to push those over. And so there's been a lot of back and forth as the episode will go into, but just curious for you, Nathan, as you've been around this space, especially in recent years, it's been very tough to be an aggregator. Do you think the business model is still viable, or have we moved past that?
Yeah, I mean, I think, like you said, this has been a successful business model across so many different industries. I think, in the past decade or less, we've seen this become very popular in the e-commerce industry. Obviously, there's very few of these aggregator companies that have proven to be successful, but I think the model itself makes a lot of sense. I think the challenge that a lot of these aggregators face, as we'll dive into with Thrasio, is that they were so hyper reliant on Amazon. And on Amazon, for those people that know, when you're selling on Amazon, you don't really own that customer, right? You oftentimes don't know their name, email, like you don't know that information. And so to me, it's quite a bit different compared to, a aggregator that's going to acquire Shopify brands or going to acquire nursing homes or whatever it may be, because they have direct relationships with those customers and can probably, cross sell and upsell across different products and brands much easier compared to, being an aggregator on Amazon. So I think there was definitely some headwinds that we'll discuss in terms of interest rates, in terms of increased competition from China and a lot of other variables. But I think, the business model as a whole makes a ton of sense. I think the biggest question that we need to ask is, does this business model for Amazon, third party businesses actually make sense? And that's, I think, something that, was really tried and tested over the past 5-10 years, really starting in 2017, if I'm not mistaken, right?
Yeah, that's right. So about 2017, 2018, there were a few companies that identified that we could go out and acquire these undercapitalized Amazon brands or D2C brands. And so the focus really was on buying brands that were doing okay and making them high performing brands and kind of stitching them in with their portfolio. In 2019 to 2021, you started to see this really explosive growth. People raised a lot of money, and there was a lot of money to be deployed. Again, this is no interest rate environment. People are seeing everything that's up and to the right e-commerce related. And so it was almost a bet on e-commerce in general, and said, well, I could bet on all these different startups. I could bet on Shopify itself. But what if I could just start rolling these up and getting these multiples on revenue on a much higher revenue number than these individual brands? And then 2022, 2024, there was kind of a rude awakening, or the industry matured, if you want to call it that. There was increased competition. There was a lot of money and a lot of players that were chasing the same smaller group of sellers. Sellers recognized that, like, hey, this was a great way to do this. I've got options. I could hold on to this for a little bit longer. I could sell it. And so the market kind of shifted on a couple different areas where people used to value these potential acquisition targets based on their own economics and what they wanted to deal with from a multiple perspective, and what they thought the ROI would be. To there was a little bit of FOMO going on, and there were a lot of brands that a lot of aggregators that were kind of like, well, if I don't buy it, this other person's going to buy it, and maybe the valuation is a little bit higher, maybe this is a little bit outside of our portfolio or our mandate, but there was a lot of reckoning that came through. You throw in all of the interest rates that rise, all those sorts of things, and now we're kind of in this reckoning phase where a lot of the LPs, the investors, are saying, hey, look, we don't have infinite funds. We're not going to give you infinite funds, and so you need to give us a real return. And you throw in some of the macroeconomic conditions. It's been very difficult for the aggregator industry over the last really 18 to 24 months. But it's one of those things where I think we'll pause for a bit, we'll consolidate, and I'm already starting to see more deals being discussed and happening, and things like that. But I'm just curious, when was the first time that you heard of Thrasio?
Yeah, it's a good question. If I recall, it was probably, I think it was actually, it's funny because I remember kind of more of the specific timeline. It was probably May 2019. And the reason why I remember the month is because I was at Sellers Summit, which is a event put on by Steve Cho, who runs another amazing e-commerce podcast called My Wife Quit Her Day Job. And he has this
Good
really
one.
cool Amazon Shopify focused event, typically in Florida. I think it was in Fort Lauderdale that year. And I want to say it was Casey from Viral Launch, which was like a Amazon growth tool that a lot of people were using, told me about this company Thrasio that he was advising. And my first thought was, oh, that's cool. I know aggregators have been successful in other spaces. And it was, yeah, I mean, I didn't, of course, know how big they would get and how fast they were growing. But, I thought it was a very unique and interesting model at the time. But yeah, it's funny. I remember the specific kind of moment of how I heard about Thrasio. I'm curious, how did you hear about them?
I think I don't know exactly where I was or what I was eating for lunch that day when I heard about them, but I know that I think it was they just kind of burst on the scene. They raised a bunch of money and they were really taking over the world, is what it felt like. And I remember thinking when I learned about Thrasio and their business model and what they were trying to do, I had this like, well, of course that's going to work. It reminded me of the first time that I talked to the founders of Hubble Contacts. Said, oh, people consume a lot of contact lenses. We're going to sell them on a subscription. And I'm like, well, of course that business is going to do well. Like this just lends itself to subscription. You're not forcing someone into it. And so to me, it made a lot of sense that this is what they're doing. And I think they went from zero, not even on my radar, to like a major force, a major piece of reckoning, kind of all at once.
Yeah, very, very quickly. And so Thrasio was founded in 2018 by Carlos Cashman and Joshua Silberstein. Carlos is a tried and true entrepreneur, right? I mean, he started about 15 companies, been a part of several more startups as an investor and advisor, some venture backed, some non venture backed. Some that he lost money on, but before Thrasio, he had already sold 6 companies, including one that went public and then sold again privately. And so he has a really strong background in strategic marketing, focused on branding and positioning. And he got his bachelor's in information technology from MIT and graduated in '94. And so he's had a really strong background in startups before founding Thrasio. I can go through the whole list, but I think what stuck out to me is he spent 4 years as the founder and CTO of Office 360, then 3 years as the president and co-founder of Course Advisor, another 2 years at the director of Peer 2, and then the CEO and co-founder of Q Notes, and then the managing partner of Orion CKB. And he has held all these kind of director and chairman oriented positions across multiple companies before founding Thrasio in 2018. And he kind of calls himself, quote unquote, the poster child for the dot-com boom and bust. So he's been through a lot of cycles before. And, as we'll see, this kind of plays a role in the timing of Thrasio as well. And I think, too, if you look at a lot of successful founders, they have this background of starting a lot of different businesses that might not get to hyper scale like Thrasio did. I mean, do any other examples of founders come to mind, or companies doing this that come to mind, to you, Aaron, in terms of a founder that, has tried for a decade and then, hits his breakout success and everyone thinks it's this overnight success?
I mean, the Viore episode that we did comes to mind where, they the founder had a company called Viore that he shut down and then just still liked the name, like the trademark, and reincorporated. And so, there are no overnight successes. It seems that the people who are overnight successes are frauds, right? You think of SBF or other folks like that are now looking at jail time or things like that, where they've done some shady stuff, particularly. Um, and so, in my experience, there's a lot of people that uh, deal with a lot of failure, or not even failure, but just like mediocre successes, right? If that makes sense. It's like I always joke when people talk to me about how many businesses I've started, or what I own, and I always tell them, like, this sounds much more impressive than it actually is. Like, I know that I could be making more money or doing different things if I went full time somewhere, but you're learning, you're gaining that experience. It's yours, you own it, right? Like, and so you're able to kind of decide where you want to go and what you want to do with it. And so it's it's an interesting thing. And so with both these guys, with Carlos and with Josh, there's very smart guys that I think, like you said, had gone through these reps over and over again, and you can't really learn that in a textbook. You can't learn that on a podcast. You have to like go through it and make your own mistakes to some extent.
Totally, yeah. And so Josh has a very strong entrepreneurial background before founding Thrasio as well. He studied economics at the Wharton School and got his MBA at Columbia Business School. There's a lot of different roles that he's played before founding Thrasio. Like, he was the CEO of Health Guru Media, the CEO and founder of Citywise Guides. A lot of media oriented approaches. And this, I think, is where part of the connection stems in the Amazon ecosystem. Is he was the chairman at Viral Launch, which was my friend Casey's company, which was an Amazon growth tool that was growing very fast at the time. And then he also spent 7 years as the director of Rally Road, which probably taught him a bit about the debt markets and acquiring different assets and whatnot. Rally Road, for those that don't know, is basically a marketplace to invest in collector and unique items. You could think a classic Ferrari or a very famous painting, and they basically fractionalize these investments. So pretty cool. And yeah, he was part of Thrasio up until 2022, 2023, and he has no new projects listed on his LinkedIn after that. And Carlos, on the other hand, actually in 2022 co-founded another company, Craigle, which he currently leads and works at. So it's pretty interesting to see these founders get so many reps before founding Thrasio. And I mean, the company history is kind of a wild ride. I mean, Aaron, do you want to touch on, the early days of Thrasio, and then we'll build up to what it got to?
Yeah, what I think I love most about the story is you had two very very capable people in their own right that came together and decided to specialize. Right, again, these guys had been CEOs, had been managing partners at several organizations before, and so they could do it all. But they kind of divided it into two spheres. Carlos had a Facebook marketing agency, and he got really good at customer acquisition. And he, was the one who kind of looked at this and said, I'm helping all of these e-commerce companies grow and get hundreds of millions of dollars in valuation, and I'm getting a monthly check. And sometimes that check was pretty big, but he's just like, hey, I'm not capturing all the value that I'm generating, but I feel like I understand these businesses, certainly the marketing side, so much more than even their clients did. And so that was kind of the initial thought that rooted in his mind. And they would have these opportunities that would come past where people would say, hey, Carlos, you guys are really rocking it. You're killing it with this other brand over here that's doing really well. We'd love to hire you. But they couldn't afford the fees, right? And so Josh and Carlos had known each other. And so they started to talk about these discussions and said, hey, there are these brands here that I know would do really, really well. They just can't afford to pay me tens of thousands of dollars a month to manage their digital advertising, things like that. And so they started to go back and forth and look at these things and say, well, they've got pretty healthy margins here. There's some areas that could be improved upon. But the thesis was that if we just plug them into this growth engine that Carlos has, that they could grow these to be, much bigger, much more profitable than where they are today. And so they decided to raise a fund, and they're like, let's go out and buy these companies directly. And they started out by investing in these brands themselves, and had the original thesis of kind of what you said. It's like, let's just go after Shopify brands. Let's go after D2C brands. It wasn't even Shopify. And what they found was that it was difficult because some of these opportunities they would see would be on BigCommerce. Some people would be on WooCommerce. Some people on Shopify. Some people would be on Magento. And just the tech stack and the differences, even a handful of years ago, between these platforms was very, very different. I think safe to say that Shopify has really done a good job in the last 4 or 5 years of, I think, leading the pack and breaking away from them. Where if a business said, "Hey, what shopping cart should I use?" My first three recommendations would be Shopify, right? But they started looking at this, and they decided that they were going to go after Amazon, and that was going to be where they started first, because Amazon had a common platform, it had a common tech infrastructure that the Amazon brand selling pillows, it has the same kind of requirements and levers as the Amazon brand that's selling scarves or dog toys or whatever else it might be. And so that's what they did, is they started looking at different brokers, found some FBA brands, and that's what they did. Nathan, what kind of sticks out to you from that initial way of how they went from the idea, seeing this opportunity, and then getting to actually buying these brands?
Yeah, I mean, I think it's an interesting approach that they had, right? Because originally they started buying or looking at e-commerce brands across the spectrum, right? Not just Amazon. And I think at the time it probably made sense just to focus on Amazon. But I think, in hindsight, they would have been smarter focusing on Shopify brands, if you ask me, and even replatforming a brand from Magento, BigCommerce or even the custom stack to Shopify. I don't think would have been as complex and tricky as, operating the whole back end of an Amazon brand too, if they just consolidated all these companies to Shopify. And then also, it's interesting to see because they didn't have like a niche focus, right? I mean, a lot of these aggregators that we've seen nowadays, or a lot of these, kind of conglomerates focus on a niche, whether it be like cosmetics or footwear or whatever it may be. For them, they kind of like started originally with this really broad reach and then dialed it in and said, okay, we want to focus on, FBA brands selling on Amazon basically. And, they had a ton of initial success, but it's just an interesting story, right? And I think it's kind of cool too how they came up with the name Thrasio. It was based on Thrasos, which was the Amazon queen, and based on a Greek term that means boldness. So they really leaned into Amazon of like, hey, this is our focus. And so they bought the domain thras.io and the name stuck. I think they kind of regret this decision because it was, a bit complex for people to pronounce and spell and whatnot. And even I know myself, when I first heard of them, I would always mispronounce their name. And I think it's just interesting to see how naming comes together, right? Because I know, like, when I was founding Sourcify, I thought, okay, well, I'm always sourcing products. There's Shopify, is there Sourcify? And I do really like our name Sourcify. I think sometimes, especially in our early days, people would get confused. Like, are you sourcing, employees for us as a business? Is it more HR oriented? But obviously we're product sourcing oriented. How did the name Isba come up to you? I'm just curious.
Yeah, I wish I could say that it was a smart thing to do or whatever, but the truth of it is, this was I was still working full time at Unilever, and my wife was getting her MBA. We didn't have kids, and so that meant that I was watching way too much TV. And I got introduced to the co-founders of Hubble Contacts, and I agreed to initially just start consulting with them as they were getting things set up. And I felt that we needed to have an LLC because that just seemed to be the thing that you do when you start to consult. And I didn't want to call it like Aaron Allpeter Inc. or something lame. And so I was going back and forth and trying to brainstorm with my wife, and she's like, "Well, what do we use this money for?" I say, "Well, let's use it as a down payment for a house. Like that's really going to be the goal here." And my wife is Russian, and so we started throwing with different words, Russian words, Swedish words, and Izba means cottage or shack in Russian. And so I said, "Oh yeah, let's just call it Izba Consulting." There we go. And initially it was never meant to be a public-facing brand or anything like that, but as I started to consult, went full time with it, it's really kind of stuck because it's this two-syllable, short to understand. We own the domain. It's one of those things that people get it, and we own that brand in search now. And it's a funny thing how it just kind of happens. But I feel like I'm probably more on the Thrasio side, where she's like, "Oh yeah, it's a name here, fine, buy it. Here we go." Whereas I feel like yours, I mean, Sourcify is such a good name. Like it's so good. I don't know how much time you spent thinking about it or coming up with it, but I feel like you put more effort into it than I did.
Well, we spent a lot of time and negotiation and effort buying Sourcify.com because our original domain was Try Sourcify. So
Okay.
that definitely took some time to get that domain, and that's a whole nother story. But I mean, Thrasio was among the original Amazon aggregators. I mean, it was kind of this whole is greater than its parts type of model that we've discussed, and Amazon aggregators were considered to be a great opportunity by investors in 2020 through 2021 and 2022. And kind of the original was called Mohawk, later rebranded as Ethereum, and it was probably the first, but there was a lot more that were more relevant. And most of these aggregators started off by focusing on distressed brands, and as we'll see, that's kind of shifted as the market got really hot. And so early on, it was super important for Carlos and Josh to really focus 100% on businesses just inside the Amazon ecosystem. And Amazon allows for these businesses to be created by anyone really with a small or non-existent structure. I mean, you as a just personal as someone individually could sell on Amazon and create a Seller Central account. And kind of this thesis was, okay, we're going to manufacture our products in China, import them, and send those products to an FBA facility, fulfilled by Amazon facility, to then send these products directly, from Amazon to our consumers. But I think one of the kind of flaws of the business is sourcing is in general very hard, as we know, through our experiences at Sourcify and ISBA. But I think when you're dealing across so many categories, so many brands, so many suppliers, it gets even more complex. And then there was that whole, challenge of these headwinds during COVID, right? Where factories were being shut down because of COVID outbreaks. Freight rates were 10x the cost at its peak than what, they typically are. It was kind of this crazy dynamic of headwinds that I think made it even more challenging for this business to work. But Amazon is search driven. It's not necessarily like intent driven, right? Like if you market or advertise on Amazon versus Facebook, it's a completely different dynamic because people on Amazon in general are searching for those keywords, whereas on Facebook or Instagram, you're just scrolling. And so it's just kind of this interesting dynamic that has come to be so prevalent in this model, right? And so since most of these businesses were pretty low investment to start, and a lot of them were like side gigs of founders, it became this like unique opportunity for an aggregator to go acquire these companies, and we're seen as a great opportunity. So, I mean, it seems to be this dynamic where aggregators thought there was kind of a limit of how far these kind of quote unquote side gigs or small businesses could grow, and they thought by bringing them together there would be much bigger opportunity. I mean, I think it's interesting too because I think every founder has faced that opportunity of like buying versus building, right? And this aggregator space, obviously the models you go buy, but you would also think too that Thrasio has these capabilities from a supply chain standpoint to build some of these products themselves internally. How do you think those internal discussions went with Thrasio?
Well, that's a good question. I mean, to some extent, they should have been the Amazon basics, right? They could have done that and just looked to see what else was going well. And then just understanding like, hey, let's go source it. Let's stand up a brand. Let's go do it. But I think that, Thrasio did a good job of just trying to stay in their lane and focus on the one or two notes that they could play really, really well and do that over and over again. And I think early on, when they stuck to just Amazon and they stuck to brands that are profitable, they did well. But I think that the challenge that they ran into was that their growth was so fantastic that you kind of have to commit to that as a lifestyle, right? If you're growing by 100% year over year, suddenly if you're only growing at 50%, that's less exciting. And so you start to compromise, you start to look at different things, you start getting outside the thesis in order to chase that 100% growth year over year. And so, yeah, I mean, I don't know if that answers your question or not, but I think that this idea that they could go out and do their own thing. I'm sure that those discussions were had, and maybe they're doing it today. But it's probably something where it's like, hey, we're buying all these businesses, we're trying to integrate them. Maybe it is good for us to say no to some things, which would be our own brands, versus just kind of keep doing what we're doing with the integration and acquisition of other brands.
Yeah, I mean, I think too, if you're trying to grow at that pace, you can't go build these brands, right? You've got to acquire them. That's for sure. I mean, and that's really the model. And Thrasio broke a record. I mean, they were the fastest company to reach unicorn status, which was crazy. I think it was like 6 months or just like
It
under a
was
year,
ridiculous. It
something
was
crazy. But I mean, the macro environment really helped for this. I mean, obviously there was low interest rates. This was a very hyped, popular type of strategy. And Thrasio was kind of the biggest name in this aggregator space. And the e-commerce market was spiking like crazy during COVID, right? So it was just, I think, great timing. I mean, one quick question I have for you, Aaron, is do you think if someone were to start a Thrasio today, would it have nearly the success that, Thrasio had in the past?
That's a good question. I mean, I think that it depends how you answer that question. If you're thinking that Thrasio was successful because there was infinite money and there was a macro trend of e-commerce up and to the right and people were just willing to shovel buckets of money at you, then like no, right? Because we know that there's no free money. We know that it's more competitive out there, and we know that there's like profit dynamics that are important. But if the question is, you know, could someone start a roll up today? Could you start an aggregator today and be successful? I think absolutely. And I actually think that today would be an even better time to be starting an aggregator or a roll up than when Thrasio started, just because there are so many deals, there are so many uh, cap tables that are being reset. And so you have the ability to go out and get some really great brands that are doing significant revenue, but may not be profitable or barely break even, that don't really have the return that they need. That if you can clear out the cap table and reset expectations, you can grow a really interesting business. I mean, it's always interesting to me where, Procter and Gamble or Unilever will divest a company, and they're like, "Oh yeah, we didn't invest in this company because it was only doing $500 million a year, and we took those profits and we'd rather grow it on something that was doing a couple $1 billion a year." Well, suddenly you sell these things to private equity, and they're like, "Cool, we have a $400 million business. That's amazing. Like, let's do all these things. Let's invest in the brand. Let's do things differently." And it's just when you change the expectations of what the cap table is looking for, you can suddenly have a very relevant and exciting brand. And how many people do we know that are thrilled with the fact that they have a side gig that's doing $50,000 a year in profit, right? Like, so again, if that's your expectation, if that's the cap table you're looking at, that may be an awesome side gig and that's something you're looking for. But if you're an institutional investor and you've deployed $200 million into a business, 50K return's not going to cut it.
Right, totally makes a lot of sense. You know the Thrasio team, pretty well. I'm curious, like, what strategies do you think they utilize to get big so quickly, and then how did the founders split up, their responsibilities?
Yeah, so there were a couple things here that they did, starting with kind of how they split things up. So again, I talked about how Josh and Carlos were two very, very strong, very smart people who could do it all, it seemed like, but they chose to specialize. And so the capital sourcing and capital allocation was always handled by Josh. And they recognized early on that they could get to where they wanted to be faster with debt. And so the thought was that if you buy assets at a low multiple and you're able to take them to a high multiple, then you'll always be able to cover the debt with no issues. And so, again, that's an important piece to understand because, again, if the asset that you're buying is growing faster than the interest that you're paying, it's basically like this infinite money glitch, right? And it works out well. As soon as that business stops growing or your interest rate increases, that's where you get upside down pretty quickly. Um, and that was really one of the downfalls of the bankruptcy. But they found that getting that capital allocation piece right, and getting the execution was just the core of the strategy. And so while Carlos focused mainly on the organization, and experimenting and like the types of things like that they need to do, he was really looking at it from an execution or a marketing point of view, and how do we really do well there. Um, and I think that the thought there was that they started to dabble again. They started chasing this growth and these other places they could be. And while they stuck to Amazon and that was really the moneymaker for the long time, they started looking at other other marketplaces as well. So Zalando or Mercado Libre, they try to see are there other international marketplaces that resemble Amazon that we could go after. And obviously the assumption there is that if we're really good at Amazon and we own that, could we do the same thing in other countries? And I guess the question I have for you is, obviously, like, they are a very small player even today in Amazon's total ecosystem, but I can understand the desire to want to try and replicate the playbook elsewhere to chase the growth faster. But when does a business see these sorts of things as a smart expansion versus a distracting side quest to the core of what they're doing?
Yeah, it's a really good question. I mean, I think number one, you got to ask yourself, do I have this expertise internally or do I have to hire and build a team for this specifically? And number two, I think it's about the economics, right? If you feel like, your cost per acquisition has gone up too much domestically and you need to expand, internationally, what does that infrastructure look like? And what does that investment look like to make that expansion? So it's an interesting scenario to think about. I mean, I think, like, I know a lot of Shopify brands in this market that have now expanded internationally, but you really oftentimes need to have a localized presence there, whether you're expanding to Europe or Australia or wherever it may be. I mean, I think these marketplaces like Mercado Libre make it easier to expand, but you still need to have, inventory there. You need to have a team member focused on that has expertise in that marketplace. It's a completely different dynamic. So, I mean, in my opinion, especially with this type of business, you should be solely focused on what you're doing and what you can do well rather than spreading yourself too thin.
I think that's smart. There is this tension because on the one hand, it's like, hey, head down, just keep doing what you're doing, and you're going to get to where you need to be. But then on the other hand, there's companies like Rocket Internet out of Germany, which their whole business model is what's working well elsewhere, and let me go replicate it in places where you're not. And they've built some very large businesses, uh, basically mimicking Amazon or Shopify or things like that. And so I think the key thing that you said was focus. And so I think that the right way to do this would be, if you've decided that this is something that you want to do, you've got to be able to carve out people that only think about this, right? Like, you almost incubate a startup within your startup, and you've got to have people that have the focus, the singular focus on just this area. I mean, this is like a hard lesson that I've had to learn is, as we've been growing ISBA and certain other companies and things like that. Initially, I was like, oh, let me do it all, right? Like, if Elon Musk can do it, why can't I? And that was like a bad idea, to try to compare yourself to Elon Musk just in general. But the thought was like, okay, you can only get it to a certain point, when you're splitting your attention elsewhere. And then you have to bring in someone else who is going to have the same vision, who's only going to eat, breathe, sleep, sweat this particular thing. And so I don't know to what extent Thrasio did that with Mercado Libre or these other marketplaces, but I think that's probably the only way that you could do that, is being able to carve people off that only do that, only think about that, and are insulated to some extent, whether it be physically or just organizationally.
Yeah, yeah, I agree. And I mean, Thrasio had a process to grow multiple brands at scale. So, at this time, the Amazon ad ecosystem was growing like crazy. They really utilized, this ad platform to kind of have this predictable process to growth from the brands that they acquired. And I mean, I think they kind of really utilized, processing data and streamlining their backend, process of sourcing and connecting suppliers and trying to aggregate some of that demand in order to get better pricing. So they really took kind of those key fundamental steps as an aggregator to make sure, hey, can we, increase our margins and continue to grow? And I think it was good timing too with the Amazon ad platform, getting so popular and more powerful. I think the challenge that maybe they misunderstood at the time was that when a lot of aggregators came to the market to acquire these Amazon brands, multiples began to rise, right? I mean, typically these companies were selling for like 3 to 5x EBITDA. And, at the height of like 2021, 2022, they were selling for like 5 to even 10x EBITDA, which, for an Amazon brand is a lot, right? So you're kind of paying 2 to 3 times more than you would typically pay for a brand. And at the time, Thrasio was not concerned by paying more because the capital markets in terms of debt was still cheap. And Carlos kind of highlighted this by focusing on the value of brands over products. And so, that is really what their kind of core thesis was. He says, at Thrasio, we are building brands. And a lot of people think like, selling on Amazon is product focused because it's so search driven. But, Thrasio's kind of whole thesis and model was, hey, we'll acquire a brand on Amazon that has multiple products with great reviews and continue to roll out more products across that spectrum. And so, it's just crazy to see how this all came together because, I mean, at one point, Thrasio was valued at over $10 billion. And when Carlos was asked about, Thrasio's risk factor in 2021, he answered that he sleeps like a baby and that Josh should too. So, it's just pretty incredible to see the scale that they got to. And, as we'll shortly dive into kind of a bit of their demise, it was a very interesting run up to see how they got this scale. And they got so much coverage. I mean, pretty much I would assume everyone that's listening has heard of Thrasio and, the news that goes around it. But eventually in mid 2022, there was, starting to have cracks in their business, right? There was, initially rumors of Thrasio going public, but 6 months into those rumors and news, it kind of quickly dissipated, right? There was news of accounting madness without a chance of going public. The CFO was replaced by another different CFO who was then who then actually resigned within 3 months at the job. And that, I think, in general is just a red flag, right? If you look at a company, whether they be private or public, and if they've gone through multiple CFOs, you know something is up there. And this, I think, really indicated that accounting and finance was in disarray. So, I mean, what ends up happening, Aaron? Because they go through like multiple CFOs, which is, I think, a red flag for everyone in the space. And there's kind of these tricklings that I'm sure you heard of at the time of, hey, Thrasio, yeah, probably at first we're all thinking, oh, Thrasio is going to go public. This is going to be a huge outcome and win for the e-commerce industry. And then we start hearing these rumors of, wait, something's up here, right?
Yeah, it was basically kind of kept going until early 2023 when they said, "Hey, we're not going to acquire anymore." Uh, and then it kind of went through to bankruptcy, later in 2023. And it's really interesting to me is that for a company that was as sophisticated as it was around capital allocation, that they were rumored to have such major accounting challenges. And it really got to me thinking about, what advice would I give for a company that's scaling, as far as, when and how to professionalize their team. And really the thoughts I had is like, I think that like even today, Thrasio is a fundamentally great business. I mean, they were profitable from day one, and they raised money to go after the growth. But I think the growth got ahead of them. There's only so much that a culture can absorb from new people coming in. There's only so much that a business can expand and do things. And so when you start to grow faster than you can, you start to look at these things and say, well, we're clearly playing a short-term game here. We're not building for a long-term future, a long-term piece there. And so I think that they probably should have recognized and maybe changed the perspective a little bit to say, all right, we think that Thrasio could be the dominant player and just seller on Amazon, period. This is our 15, 20-year plan in order to get there. And so let's get aligned on that vision. Let's make sure that the investors are okay with what it's going to take to get through there. Let's make sure that they're okay with maybe not a huge flash in the pan sort of big valuation pop, which is what they were being pushed to do, and then start to attract people around that vision. I think they have an opportunity now that they are resetting with the bankruptcy, to basically be able to start over to some extent, to wipe the slate clean, and to say, okay, here's where we're going. Here are the milestones that we're laying out. We are willing to leave some opportunities on the table, but we're going to protect what we've got. We're going to go forward. But I'm just curious, that's how I would answer the question. But what would you give to a company that's scaling quickly as far as when and how they should start professionalizing?
Yeah, I mean, I think if you can professionalize from day one, that's the best thing you can do, right? I mean, I've advised and consulted and helped with growth on so many different brands and SaaS companies now that you need to store all your contracts in one place and be able to pull them up for typically the past 5 years when you're going through an acquisition. I mean, it's best to have all that information organized from day one, right? And it's really challenging to comb back through when you're going through that process of growing and scaling and trying to figure out how do I connect all the dots. And I think too, in Thrasio's case, when you raise so much capital and have so much debt, it's hard to organize, right? I mean, I even have been working with a brand right now that is facing some cash flow issues. And the challenge that I've come across is that there's no real way to determine, like in your accounting system, whether it be QuickBooks or NetSuite or Finaloop, or there's so many tools, but what they don't really do is tie in when your credit card bills are due and when your supplier payments are due and when your debt payments are due, whatever it may be. Like it's kind of baffling to me actually that no one has built this tool where you can really reconcile and understand, hey, I know this credit card bill is due on August 27th and this one's due on September 8th, and my net 30 terms for my supplier is due on September 20th, and there's not really a easy way to reconcile those payments. And so what I imagine happened is that, Thrasio, it was a lot of different headwinds as we'll kind of discuss, but,
Yeah.
they had challenges reconciling all of their capital and understanding, hey, we've got this payment due and this payment due then. And it just becomes this kind of mess that obviously CFOs don't want to deal with. And so they went through, a few of them pretty quickly. And I think it was interesting too, because as part of the bankruptcy procedure, the new CEO had to, basically prepare a document that was like giving an overview of the point of view from Thrasio's angle. Did you see that, Aaron?
Yeah, that was super interesting. I mean, they pointed to a few things. The first one was COVID impact, and they said that, like, everything was up and to the right. We took on more debt than we probably should have in order to be acquisitive, and we wanted to take advantage of the turmoil that was going on with people being, shut in. With that equity and debt that they raised, they hired too much too quickly. They brought in too much inventory, because they thought that demand was always going to be up and to the right. And to be honest, like, if you're just looking at the data from that period of time, they were out of stock perpetually, and some of that might have been port delays, some of it might have been demand related, but they basically assumed that if I didn't sell something today, I could sell it tomorrow, and so, like, let me just have a little bit of extra. The second piece they pointed to, and really the other half of it, was just the operational strategic missteps they did. And so again, they said all of this was very logical at the time, but they basically overbought inventory. And they said they had $425 million of excess inventory, not total inventory, excess inventory at the end of 2022. And it's just that's a lot of money. That's a lot of inventory. It's several warehouses full of just their stuff that they're going to have to bleed through probably over the next couple of years. That at this point, they did recognize that they had a little bit of an over reliance on Amazon, and they hadn't done enough to grow those brands outside of Amazon. So as the algorithm changed, as just people's preferences shifted from, say, Amazon to Temu or something like that, they weren't able to capitalize on that because they were really hitched to that wagon. There were a lot of other attempts to grow Thrasio, with you know not so great brands, which really stretched the team and the focus. And so they had tried to grow through acquisitions in India and Europe, which were important growth factors, but kind of get into what we were talking about earlier about having the focus. That seemed to have been a big distraction of people. And so you spend that kind of money to acquire those companies, you kind of have to see it through. But if you're trying to juggle other things and the core business isn't doing well, it can be really challenging. I think in general, aggregators try to position themselves as solving a lot of scalability issues with tech, but in some cases, the aggregators just aren't building much technology. They're still buying third-party tools that help with SEO and fulfillment and things like that. And to some extent, you do want to buy the best that's out there, but if you're buying the same tools that the other aggregators doing, and you have the same debt structure and you're going after the same deals, you're going to get a similar result. And so I think that some of the aggregators I know of have actually really understood this, and they have invested quite a bit into machine learning, AI. They're doing like all of their forecasting and cash management. So I think that tool that you mentioned doesn't exist yet. I would guess that probably in the next 18 to 24 months, we're going to see quite a few tech companies spin out of aggregators, because they have this built-in data set, and these built-in clients to say, hey, yeah, we've got 30, 40 brands. We're going to solve this problem for all of them, and we're going to tweak it. We're going to make it work for us. And then, great, now there's value to this. Let's throw a brand on it and go sell it to other folks, and get that data and make our models even better. So yeah, it's a challenging thing there. But from Thrasio's point of view, I can see what they're saying. Obviously, the financial issues, the being over leveraged with debt, the debt becoming too expensive. I think at one point the debt was had like a 15% interest rate. Those are all things that kind of knock them out of the running. Um, it's unfortunate, but I think it's also an important step that they took, with sober look backwards.
Yeah, yeah. I mean, it's interesting to see how this all unraveled. I think it was kind of like it was interesting because it's kind of like the perfect storm that they grew with, right? Like the kind of hurricane was growing and it got so big that then when it landed on shore, it just kind of was faced with so many headwinds that it really just came crashing down. I mean, there were so many different headwinds that we could discuss in terms of port delays or rising interest rates. I mean, one question that I do have that I'm not quite sure with these aggregators is, like, it was mentioned that at one point Thrasio had kind of agreed to pay an interest rate of as high as 15%. And I mean, like, do these aggregators fix their rates? Because I know also with some bigger roll-ups like Vista Equity or whatever it may be, they've had struggles with rising interest rates as well, because it's across the board, for these aggregators that debt is impacting them. But I would think it would be smart, if you're going to do a deal and you're doing a deal with debt, it would be smart if you can to fix your rates. That way understand, hey, I know I have to make this payment, every month or every quarter.
Yeah, I don't know the specifics of kind of their debt structure. I would imagine that two things happen. The one is that they were going through so much debt, I mean, hundreds of millions of dollars, that whatever facilities they had, they were going back and renewing and saying, hey, we need more, we need more, we need more. And so even if they had fixed rate debt facilities, maybe it was only for $5 million and they needed $100 million, and
Mm-hmm.
so you go out, you try to line these other things up. And the second thing piece too is that I think that from a lender perspective, if I were, if interest rates today were at 5% and you wanted a fixed rate, well, I might give you a variable rate at 7 or 8%. But if you want fixed rate, great, here's 20, right? Because I don't know which way they're going to go, and so I want to make sure that I'm taken care of on that end. And so the fixed rate can bite either way. And I would imagine that, given how smart the investors were, how smart this team is, that they looked at this and said, okay, this is the best strategy, the best pace for it. I don't know if there's a situation where they were paying like 7% and then it shot up to 15%. But yeah, it wasn't good. I guess
Right.
is where he ended up.
Right, right. Yeah, so I mean, Thrasio now is going through its bankruptcy process. Bankruptcy doesn't necessarily mean that the company is done for. This was a Chapter 11 pre-packaged bankruptcy, so it's basically a reorganization or restructuring, unlike a Chapter 7 that implies liquidation. And this should allow it to fulfill their obligations and kind of renegotiate with creditors and debt holders. And the company enters under the supervision of a court, ensuring that nothing sketchy is taking place. And so Thrasio will probably live on. Some of its stakeholders will obviously recognize massive losses, and they'll try to right size the business. Right, they've brought in new leadership. I mean, after emerging from Chapter 11, Greg Greeley from Amazon got replaced by Stephanie Fox, who was the former COO of the company, employee number one at Thrasio, to take on the next steps. So it is kind of crazy. They've gone through 3 CEOs in 2 years, four if you consider that Carlos and Josh were co-CEOs. But e-commerce businesses in general are cash intensive. So you've got to have the money to take care of your balance sheet and understand your cash flow. But I think in general the market still trusts their team. I mean, I know through their bankruptcy process, they've been selling off a lot of their brands and the inventory involved with those brands for a major discount, which has been interesting to see because I know a lot of other kind of smaller brands or smaller companies that have been acquiring some of their assets for a great price right now. And it's interesting because I think Thrasio is trying to refocus. What have you heard through this bankruptcy process, Aaron?
Yeah, I mean, their team that they have is fantastic. So they still have some really really sharp people that are working there and are some of the best operators that I've met anywhere. And so I think that you look at the value that Thrasio has built. Obviously, they're still the name brand. If you were going to try to exit to an aggregator, they have a world class operations team, and now they've got this opportunity with this bankruptcy to wipe the slate clean. And so I think that you know the Thrasio is going to continue to be there. They're going to do well, but I think that they are bringing their expectations back down to earth. They've got a little bit more um, realistic thoughts of what's good milestones where they need to be, and they're looking for profits today versus profits 10 years from now. And so I think that recalibration, the shedding of assets that maybe aren't working well, being able to they've wiped out the debt, so they're just trying to get look at these brands and say, okay, uh, if we've got a couple of brands here that are throwing off 20K in profit, do we want to put $250,000 into that to make that 20K 80K, or would we rather just save that and then put that $250,000 into the brand that's doing $10 million in EBIT and make that 15? So those are the sorts of calculations they're looking at. It doesn't mean that these brands that they're selling are not good. It's really just they're calling it so they can be more efficient with their capital, which was kind of their secret sauce to begin with, which is where they kind of got away from.
Yeah, I mean, I think it's kind of that dynamic that has changed in the startup landscape of growth at all costs versus, really focusing on profit. And more sustainable growth. And it's just interesting to see how Thrasio's played out and where it's at. I mean, I think the model has changed, quite a bit in terms of this industry. I think, like you said, there's still opportunity to create an aggregator with a very niche focus. But there's other headwinds as well with the rise of Temu and Shein that are really selling just incredibly cheap Chinese goods across social media and the marketplace in America. And Amazon, this has even impacted Amazon, right? Because Amazon is now reportedly planning to start its own kind of direct from China storefront to compete with Shein and Temu. And so I think that's going to impact every third party seller on Amazon if they're now having to, go and compete with a product that's being sold directly from a Chinese competitor for, 50 or 80% less. And, though the shipping time might not be 2 days with Prime, it's now, a week or a week and a half. I mean, that's a question that a lot of consumers are going to be asking themselves of, am I willing to, wait 14 days, but pay 80% less? I mean, I think a lot of people will take that bet and pay a lower price. So it's interesting just to see how the marketplace is changing with the rise of these Temu and Shein type shopping apps. And I mean, I think it's interesting to see like the impact that Shein has had on this space. I mean, do you think this is coincidence? That these companies have grown while most aggregators have kind of faltered. What do you think is this kind of dynamic between the two?
I mean, the thing I walk away with is that companies like Thrasio were the luckiest companies in the world, and then the unluckiest companies in the world in like the span of 6 months. I mean, you look at when they started up and to the right with e-commerce, massive booms, and Amazon, a massive amount of willing sellers of those businesses, and then it flips where maybe Amazon isn't the right place to be anymore, right? And you look at Shein and Temu and just the shift of kind of consumers going over there, the difficulty in being able to build and defend a brand on Amazon. And so it was just really difficult. I mean, they rode a wave to some extent and then, didn't bail. So nothing got crashed on.
Yeah,
I think
yeah,
their timeline's really interesting. We haven't walked through that yet. Do you want to walk through that?
yeah. Let's do it. I mean, so the timeline founded in 2018. Crazy stat to start with. They actually doubled their revenue every 73 days on average for the first 2 years. So, I mean, just let's pause and take a minute to think about that. Doubling revenue every 73 days for the first 2 years. That's just insane.
Even if you start at like
2019.
$100, you get pretty big pretty quick.
Yeah. Oh, yeah. I wish my investments looked like that. 2019, they raised a seed round of 6.5 million and a Series A for 20 million. They're doing about 20 million in revenue that year. 2020, they have a Series B for 75 million. And at this point, the company's valuation is already $700 million. They then raised a Series C for 260 million. And this was subscribed solely by Advent International. And by mid 2020, they'd already become a unicorn, 500 million in revenue, 1,000 employees. So basically, in 2 years, they grew to $500 million in revenue and 1,000 employees, which is just insane. 2021, they raised 500 million in debt and a Series C for 750 million. By Advent International and Oak Tree Capital Management, and then another Series C of 100 million, which I think was an extension, post money valuation of 3 billion, and then another debt financing of 650 million, then a Series D of a billion, which was by Advent International and Silver Lake. So they go from 3 to 5 billion in that round and 1,500 employees. 2022, a undisclosed amount a venture round. Company Thrasio lays off 20% of their staff. And then 2024, they file for bankruptcy. The company has reached an agreement with its lender to reduce its debt by approximately 495 million. And Thrasio has secured more capital, up to $90 million, aimed at supporting their ongoing operations and sustaining and growing their brands within their portfolio. And so, I mean, I'm not too familiar with Advent International, but it seems like this was a huge investment for them. They invested really several $billions of equity that has been wiped out essentially. We'll see now. Thrasio seems to be in a more stable position, but I mean, the media basically portrays the bankruptcy as a victimless activity. But I mean, you've had some conversations, Aaron, with LPs about some of this dynamic. I mean, can you tell a bit about what have you heard from LPs?
Yeah, and this is just generally not specific to Thrasio, but you know, Advent really took it on the chin on this one, right? They underwrote quite a bit of this and ultimately walked away with nothing. I mean, that's what happens in a bankruptcy, is that the equity holders walk away with close to nothing, in most cases nothing. And this was basically a coup where the lenders took over the business. And so great deal for the lenders. They're still going to get some of their money back, but now they own really the pinnacle of the aggregator space, like the name brand company that's out there. And you think about this from an LP point of view, and they're like, where is this money coming from? Well, it's coming from pension funds. It's coming from investment funds. It's coming from um, wealthy individuals, things like that. And so this money did come from somewhere, and it's intended for a purpose. And so to see that, $1 billion worth of money is wiped out in wealth, that mean, it's like, oh yeah, these guys, these fat cats, whatever. But if that came from a pension, right, or a retirement fund, those are sorts of things that could have big impacts down there. So what I was doing is I was talking to a lender who had loaned a company tens of millions of dollars and was, you know, kind of there as a coach, wasn't an equity holder. But then when this business defaulted on their loan, they took control of the company. And as a result, they kind of looked at this and said, all right, we have this asset. We really just want our money back. Like that, we don't want to run this company. We really want this money back. And so what they end up doing is they end up having to hire the founders again to basically give them new equity in that business, even though those founders are the ones that ran the business into the ground and were responsible for, ending up with, being in bankruptcy. And so there's a extent here where this lender felt that they've been taken advantage of because there was, they were on the hook for kind of losing this investment anyways, and then they had to go back and hire the people who kind of caused the problem because they didn't want to run the business themselves. And so there's just this weird dynamic that's playing out with lots and lots of companies at different scales where people are, kind of looking at this. And so I don't know. It's like this weird thing that's happening where, in some cases, I'm seeing founders and companies get booted out and are leaving. In other cases, they are just resetting the cap table, and the only people that have lost money are the investors. I know several folks at Thrasio who were there before and afterward. And I asked, hey, what happened to your options? Like, well, those are worthless. But if they're going to keep me, they're going to issue me new options in the new company. And so, we'll just restart the clock and maybe it's a different valuation, but we're basically wiping the slate clean, starting over. And so to that extent, from an employee perspective, it's great. It's kind of victimless at that point. But really from an investor point of view, those are the ones that get hosed. And, it is risk capital. So I'm certainly not saying that you shouldn't lose money. But if anything, I think that this was a failure of the board, right? Like Thrasio's board should have been so much more involved. And again, the tea leaves at the time said everything was up and to the right. But if you go from 20 million to $500 million in revenue in 1 year, that's a lot, right? And maybe they should have been more forceful about professionalizing to figuring out the financing stuff earlier. They should have been a lot more involved with this cash cow, maybe throttle the growth a little bit. But so I don't know, I'm kind of rambling at this point, but it kind of feels that on one hand, because the equity holders make up the board, they kind of got what they deserved by the lack of oversight. On the other hand, I can certainly feel from a lender perspective how difficult of a position they're in.
Yeah, yeah. I mean, I think that's a great summary of what's been going on with Thrasio. I think, in general, markets have changed so quick over the past, really 2 years. I think it's challenging for all parties involved, whether you be an LP in a fund that's losing money, whether you run a fund, whether you be a founder, or whether you're an employee with options, and now your options are reset, right? I mean, you work, 4, 5, 6 years for options that are worthless, and a lot of people, when the company was worth $10 billion, I'm sure they were doing the math, and on paper, they, many of them were probably
Yeah.
millionaires on paper, right? So, I think it's really challenging for all stakeholders. We'll see what happens to Thrasio in the future, right? I mean, as they come out of this bankruptcy proceeding, I think there is, still a lot of opportunity for them, but they have to be a lot more diligent, like you said.
Yeah. I don't know. I still like the company. But I think that they probably have the potential of being a great $100 million business, right? Of just sticking and doing the blocking and tackling of just Amazon and just doing that. But like, I want to grow a bigger business than kind of where I naturally would be, right? And so I get the temptation, I get the thought there. Um, Hopefully everybody involved has learned a lot of lessons, and it'll be a much stronger company in the years and decades to come. Because I think that this is just we're gonna look back on this in 5 years, and this will be a footnote in what otherwise is probably a very successful history of Thrasio. But it is an important milestone. It is, I think symptomatic of where the ecosystem in general for startups is right now, where you had such a huge change with interest rates, huge change with funding, huge change in profitability expectations that they've really, you know, have felt that because of the leverage that they were carrying.
Totally, totally. Well, we appreciate everyone listening in to this episode of E-commerce on Tap, brought to you by Source Finance. But if you have questions for Aaron and I about Thrasio or have interesting tidbits to share, let us know on LinkedIn or Twitter. I'm curious, what did you think of the story? Had you heard of, Thrasio and their crazy scale and growth? And have you, seen any unique insights from the bankruptcy proceedings? Curious what you've learned from this, story, and really appreciate you tuning in. Please like, subscribe, leave a review. It helps e-commerce on tap a lot. And thank you again for tuning in.